Imagine waking up one morning and realizing that the economic bridge holding an entire continent together has just cracked overnight. No warning sirens. No slow collapse. Just one announcement. And suddenly trucks are stuck at borders. Markets are shaking. And businesses on both sides are asking the same question. What just happened? This is not a movie plot. This is the shockwave sent through North America after Trump's proposed 100% tariff on Canadian goods. A move that didn't just hit Canada, but rattled the entire $2.4 trillion trade system connecting the United States, Canada, and Mexico. What you're about to hear explains why this decision is being called one of the most disruptive economic gambles in modern North American history, and why its consequences may last far longer than anyone expected. For decades, North America functioned like a single economic engine. Parts crossed borders multiple times before becoming finished products. A car assembled in Michigan might contain steel from Ontario, electronics from Mexico, and components shipped back and forth half a dozen times. This system wasn't perfect, but it was efficient, predictable, and incredibly profitable. Then came the tariff bombshell. A flat 100% tariff on Canadian imports is not a small policy tweak. It's an economic sledgehammer. Overnight, the cost of Canadian goods entering the U.S. effectively doubles. That doesn't just hurt exporters. It hits manufacturers, retailers, workers, and consumers almost immediately. Before we go deeper, if you value clear, no-nonsense breakdowns of what's really happening behind market headlines, take a second to like this video and subscribe to the channel. It helps Market Truth Archives keep bringing you stories that actually explain the world you're living in, not just the headlines flashing across your screen. Now let's slow this down and understand why this move is so explosive. Canada is not some distant trade partner. It is America's largest trading partner. Every single day, nearly $7 billion in goods and services move across the U.S.-Canada border. Energy, lumber, agriculture, automobiles, machinery, metals, chemicals, food. These are not luxury items. These are backbone industries. Slapping a 100% tariff on them doesn't pressure a foreign rival halfway across the world. It pressures your neighbor, your supply chain partner, and ultimately your own economy. Supporters of the tariff argue that it's about leverage, that Canada has taken advantage of trade deals, that American workers need protection. But here's the uncomfortable truth most people miss. Modern trade is not a zero-sum game where one side wins and the other loses. It's deeply interconnected. When you double the cost of Canadian steel, U.S. factories that rely on that steel don't magically switch suppliers overnight. Te paie more, or they slow down production, or they lay off workers. And those costs don't disappear. They travel down the chain until they land squarely on the consumer. Think about housing. Canadian lumber plays a massive role in U.S. home construction. A sudden tariff surge pushes lumber prices higher, which pushes home prices higher, which pushes rent higher. This isn't theory. We've seen it before. During earlier tariff battles, construction costs jumped, projects stalled, and affordability dropped. The same pattern repeats, just on a much larger scale. The auto industry might be the hardest hit of all. North American auto manufacturing is a tightly choreographed dance. Parts cross borders multiple times before final assembly. A 100% tariff doesn't just add cost once. It compounds cost at every crossing. That means higher vehicle prices, slimmer profit margins, factory slowdowns, and potential job cuts on both sides of the border. Ironically, a policy framed as protecting American workers could end up hurting the very factories it claims to defend. Markets reacted fast, and not in a good way. Investors hate uncertainty more than bad news, and this move injected both at the same time. Stocks tied to manufacturing, transportation, and retail felt immediate pressure. Currency markets shifted as traders tried to price in retaliation risks, because that's the other half of this story that rarely gets enough attention. Trade wars don't happen in one direction. Canada doesn't just absorb the hit and stay silent. Retaliation is almost guaranteed, whether through counter-tariffs, regulatory pressure, or shifts toward other trade partners. And that's where the $2.4 trillion trade framework starts to unravel. Once trust breaks, deals become fragile. Companies that spent decades building cross-border supply chains suddenly start rethinking everything. Some delay investment. Some move production. Some simply freeze and wait. All of that slows economic momentum. Growth doesn't collapse instantly, but it bleeds out slowly, quarter by quarter, job by job. There's also the political layer. Tariffs sound tough in speeches. They fit neatly into campaign narratives. But governing is different from campaigning. When prices rise and voters feel it in groceries, gas, housing, and car payments, support can evaporate fast. Economic pain is personal. It shows up on credit card statements, not policy papers. What makes this situation even more dangerous is timing. The global economy is already walking a tightrope. Inflation pressures haven't fully disappeared. Interest rates remain elevated. Consumer confidence is fragile. In that environment, adding a massive trade shock is like shaking the bridge while traffic is already backing up. You don't need a collapse to cause damage. Even hesitation can be costly. Some argue that this is just a negotiating tactic, a threat meant to force concessions. Maybe. But even threats have consequences. Businesses don't plan based on political optimism. They plan based on risk, and the moment a 100% tariff becomes thinkable, the risk profile of North America changes. Long-term contracts get questioned. Expansion plans get delayed. Capital looks for safer ground. This is why economists keep warning that the biggest cost of trade wars isn't always the tariff itself. It's the uncertainty it creates. Once companies start building parallel supply chains or moving production elsewhere, those changes are hard to reverse. Even if tariffs are later reduced, the damage to trust can linger for years. At its core, this story isn't about Canada versus the United States. It's about whether North America continues to function as an integrated economic powerhouse or fractures into competing silos. The $2.4 trillion trade system didn't appear overnight. It was built over decades, through agreements, cooperation, and shared interest. Breaking it is easy. Rebuilding it is not. As you listen to this, ask yourself one simple question. If prices rise, jobs become less stable, and markets grow more volatile, who really pays the price? It's rarely politicians. It's workers, small business owners, families trying to plan their future. That's why understanding these moves matters. Even if trade policy feels distant or boring at first glance, this is exactly why Market Truth Archives exists. Not to take sides, but to pull back the curtain and show how decisions at the top ripple through everyday life. Because behind every tariff headline is a supply chain. Behind every supply chain are jobs, and behind every job is a household trying to stay afloat. Now, I want to hear from you. Do you think aggressive tariffs protect national interests, or do they cause more harm than good in today's interconnected economy? Drop your thoughts in the comments. Your perspective matters. And these discussions shape how people see what's really happening. If you found this breakdown useful, share it with someone who cares about markets, jobs, or the future of North America. The more people understand the stakes, the harder it becomes to ignore the consequences.